All right, fellow AMC ape holders, X-Max Trading here. I want to go over some DD about naked shorting from Benzinga, which came out just 2 days ago, versus the one in June. They kind of admitted the whole naked short selling scheme. So let's hear what they say. What to know about naked shorting? Dylan Spear, Benzinga staff writer. Thousands of traders, blah, 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 whatever. Naked shorting is a legal practice of short selling shares that have not been affirmatively determined to exist. And naked short means a trader believes the future value of the stock will be worth so much less than its current value that they ask a broker to lend them artificial shares to increase their further position's profitability. In comparison, in legal, a long position means a trader believes future price stock will be worth more. Short position means a trader believes price will be worth less. Melvin Capital is estimated to have borrowed 177% of the stock float to be a naked short. In other words, if there are 100 shares of GameStop purchased or sold, the short would have been allowed to borrow 177 shares. While there are many parties that oversee naked short selling, the fundamental practices are blurry and marginally enforced. For a naked short, a hedge fund usually asks the prime broker for naked shares. Nick Cannon, Benzinga's options trader, assists the entire market every single day to give you the best. Well, whatever. Unlike, I got bamboozled there, looking for the text. Unlike a conventional short, in which the borrower and prime broker must locate the shares before they are borrowed, make sure the shares actually exist, naked shorting requires no proof that either the borrower or a broker can cover their position or prove there's enough shares in stock float to borrow the desired amount. In other words, no one checks to make sure the naked short borrowing is more shares to short than the float. In other words, no one checks to make sure the naked short is borrowing more shares to short than shares in the float. No one's checking. This may be the reason why GameStop short squeeze is so brutal on Melvin Capital's bottom line. The hedge fund borrowed more shares in existence and couldn't possibly cover its short position when the stock price explosively rose from $4 to ultimately $4.83. Many believe GameStop's stock popularity and relevance were the only reason Melvin Capital's prime broker was forced to cover. In a conventional naked short position, the fund has the option to fail to deliver, meaning that when the margin call comes, the firm can declare an FTD and is given another day to cover their position. The catch: FTDs can be claimed every day, so there's no limit in place to limit the number of times a firm can fail to deliver before it's only covered in the short position. Although I think when the price increases, the borrowing fee increases, then it becomes more pressure in my view. But just my opinion, not financial advice. When GameStop and AMC Holdings opened the public eyes to illegal practice of naked shorting, it's important to understand the practice is as old as the traded market. So that's your excuse, huh? All right, Benzinga, that's your excuse. This Nick guy is talking about his blah blah blah, his trading thing. It's as old as the traded market. So is it the oldest profession in the world is naked shorting? It must be the oldest profession. That's what it must be. You know, back in the old days in the Greek times, there's naked shorting going on even there. All right, enough of the jokes, guys. See you later.